Welcome back, students, for class number 22 on CMA and financial management. So today is our last class on budgeting and budgetary control. So after this class, we will be moving to standard costing. So yes, we will go on to today's class. So today's problem is three articles X, Y, and Z. So there are three items or three products X, Y, and Z produced in a factory. They pass through two cost centers, cost center A and cost center B. This is something like, for example, a particular metal part has to be first washed and then cleaned and then sent for the machining purposes. Okay, all these three will be like a separate separate production shop, or you can call it as departments, or you can call it as cost centers, and all the costs related to those cost centers will be accumulated by them. So likewise, this factory has two cost centers, which is A and B. So from the data furnished, compile a statement for budgeted machine utilization in both the centers. So what is the budgeted machine utilization that will happen? So we have to make a statement of machine utilization. So we have to put budget for the machine utilization. So all the details are given here. We are just going to frame the machine utilization budget. So what are the details that is given? Sales budget for the year. So sales budget is given. So what is that? So for all the product X, Y, and Z, annual budgeted sales is given. So but we have to do the budgeting for budgeted machine utilization. So machine will be utilized for production. Okay, so what we need to know is production quantity. But what is given to us in the question is budgeted sales quantity. So we have the sales quantity, we have the opening stock, and we have the closing stock also. So we know the formula, say whatever is the quantity sold or sales plus closing stock minus opening stock will be the production. Let's apply that formula for X, Y, and Z, and we can find the production quantity of X, Y, and Z. So here I am taking X, Y, Z in the column. First, I'm calculating for the cost center A. Let's make the machine utilization budget as asked in the question. So sales quantity is given here 4,800, 2,400, and 2,400. I have put the sales quantity. We have to add the closing stock. Closing stock is given as equivalent to 2 month sales. So what is 2 month sales? 12 month the sales is 4,800. So 4,800 divided by 12 should be 400. So into 2 for 2 months, it should be 800. So there is a small tricky situation for calculating the closing stock. So I have calculated the closing stock. Okay, it is 2 months of sales. So sales is given for 12 months. So divided by 12 for 1 month sales we can calculate, multiplied by 2 for 2 months of sales is going to be the closing stock. So that is the norms, and norms are usually taken for the budgeting purposes, and that's why we are taking this for our calculation. So the budgeted closing stock is also taken. We are adding the sales and closing stock and reducing the opening stock from this to find the production quantity. So we have found the production quantity. So machine hours. So we have to do the budgeting for the machine utilization. So the question is given you additional detail. Machine hours per unit of product. X needs 30 hours, 30 machine hours for finishing the cost center A. The duties or activities in the cost center A can be finished machine hours per unit. So 30 machine hours is required for making X, completing the activities of X in cost center A. Okay, same way for Y and Z, the data is given. The same data is given for the cost center B also. However, currently we are working for the cost center A only. So I'm taking this machine hours 30, 230. Okay, 30, 230. I'm taking it here. This is for per unit. It is given in the question. This machine hours is for per unit. So how much is the production quantity of X is 5,000 is the budgeted production quantity, multiplied by the machine hours per unit will give the total machine hours required for making X. Same way we can multiply and find the total machine hours required for Y, product Y, and product Z also. Now The total machine hours required for X, Y, and Z can be totaled up and find the total machine hours that is required in the cost center A will come to 7,10,000 is the total hours that is required. Now the total number of machines is given in the question. As total number of machines that is there is 284 in cost center A, but the total working hours during the year estimated as 2,500 hours per machine. So it's given total working hours during the year estimated as 2,500 hours per machine. So per machine 2,500 hours is estimated. So what we are making is machine utilization budget. So till now we have calculated what will be the total machine hours required at cost center A for X plus Y plus Z. Everything put together, total machine hours required will be 7,10,000 for the full year, and per machine it requires 2,500 hours during the year. So how many machines are required? So 7,10,000 divided by 2,500. So number of machines will be 284. And a good thing about this problem is the answer is also given in the question itself. Okay, the cost and number of machines in the A is 284. So you can work out this, just a statement presenting the facts given in the question. Only thing is we have to calculate the production quantity from the sales quantity. We should not apply directly to the sales quantity because machine utilization happens for doing the production activity. So you have to find the production quantity. So that is the key factor in this problem. Remaining things are easy. This problem cannot go wrong itself. So the student has to have to select this in the while if this kind of problem comes in the examination. So the same thing if you apply, you can find it for cost center B. Now I'm moving to the next slide for calculating the same thing for cost center B. So now it is for A, I'm changing it to B. So this is for cost center B. Same way the sales quantity is same. We are adding the closing stock and reducing the opening stock to find the production quantity, and machine hours is also given in the question for cost center B. Use the appropriate machine hours per unit. You can find the total machine hours for X plus Y plus Z for the full year at cost center B is 6.4 lakhs, and 2,500 hours per machine is the estimated hours per machine. So that is given. So total number of machines will be 6,40,000 divided by 2,500, 256, which is also the data given in the question is also right. At the same time, we have validated it, and we can also cannot go wrong if we attempt this question. So this is what is asked in this question. We have presented all the details that is already available in the question in a presentable format. So do not miss this type of question if you get in your examination. Let's move to the next problem. So this is the illustration number 12. This will be the last problem that we are solving on the budgeting chapter, and next we will dive into standard costing from our next video onwards. The monthly budgets for manufacturing overhead of budgets for the manufacturing overhead of a concern for two levels of activity were as follows. Okay, so they have given the monthly budget for two levels of activity. If the capacity is 60% and if the capacity is 100%, so two levels of activity has been done in the budgeting. So why a company has to do this kind of budgeting? Because any company will be willing to do 100% of the capacity they have, because they have invested their money in generating the capacity, though they have to utilize the capacity to the fullest, which means there is a adequate sales demand which is pulling our capacity. So we are utilizing the capacity 100% by producing it and meeting our sales demand. But here the company forecasts some threat. Maybe some competitor is also planning a similar kind of product, or a new foreign company is coming and investing on same type of product. Because of this, the company is afraid of the thing, or the company itself forecasts some other risky scenarios or some other threat from the supplier. The supplier may go bankrupt or any other risk is forecasted, and as a whole approved by the risk committee of the company, they come and say that let's do the budgeting for the 60 percentage also. Okay, so the company has done two levels of activity. So as a finance department, you have to review with all the functions and you have generated two budgets. One is for 60 percentage capacity utilization and one for 100% capacity utilization. But one good thing about here is the units is, if it is 60% capacity, it is 600 units. And if it is 100% capacity, it is 1000 units. So this is very easy. Okay, so because 60% 600, 100% 1000. So this looks like very proportionate figures. Okay, next they have given the wages detail, consumable stores, maintenance, power and fuel, depreciation and insurance. These are all the cost of taken from the P&L, and what is there is the total of these cost we have put on the respective budgets. Okay, 60% budget and 100% budget, we have filled in all the details, and total cost is also given in the question, which is the sum total of all this. You are required to indicate which of the items are fixed, variable and semi variable. So that is the first thing. So here the wages, we are considering it as a direct labor and we are keeping it as variable. Okay, but practically in the company, some costs of professional, for example, if you complete your ICWA and getting recruited as a finance executive, your cost to the company is not going to vary with the units of production. For example, if your pay package is 5 lakhs per annum, that is going to be a constant figure even if you produce 1 lakh unit or 2 lakh units of production. But that is not the case for the direct labor. So as a finance executive, your salary will be like a fixed cost or fixed overheads. But however, in all our problems, in all our philosophies that we are dealing with, we are dealing with a wage. So wage is something very related to the labor. Salary is very relatable to the executives like us. Okay, so we are taking this as for labor expenses or direct wages or direct labor cost, and we are taking it as variable in nature. Second thing is the consumable stores. Yes, the consumables are the items which are used for generating the end finished goods. So as the number of finished goods increases, the consumable consumption will proportionately go up. So we can name it as variable. Maintenance. So what is maintenance? Maintenance is a cost, but is it directly variable with the product? For example, maintenance can be classified into, some maintenance will be a mandatory maintenance and some maintenance are required for specific production. Okay, for specific production. For example, a company is manufacturing two uh, two or three products. So first the production line will be adjusted or optimized for producing the product A, and then they have to change over their production line to manufacture the product B. It may require different ingredients, it may require different consumables, different materials. So the maintenance department will come and they will overhaul the machine, take out all the materials relevant to the A, do the relevant maintenance settings for setting of the machine, and then they will go so that the product B can be manufactured on the same production line. So this, now the maintenance department has come and worked on it. Okay, and this is the cost of maintenance. They would have used consumables, grease, oils, the labor expenditure. So these are all maintenance cost. These are all not directly variable, but they are all not fixed also. Okay, because some level, some it will, there will be a lot of variation. For a particular year it will be 10,000, for the next year it may be 20,000. Maintenance activity would have gone up because the production volume has gone up. So which means it varies with the production but not exactly. So it is not variable and it is not fixed also. So it is in between these two, and we are naming it as semi variable. The same case applies to the power and fuel also. The power and fuel is required for if there is an office complex within the factory, and the light will be working in the office complex always. So the electricity will be consumed even if the production is running or not. So it is not directly variable. At the same time, it will not be fixed also. There will be some machine when the production is going on, at that time the electricity for the machine is variable in nature. So overall power cost, if you see, there are some variable portion, there are some fixed portion, and whenever there is a fixed plus variable in a particular expenditure, we call it as semi-variable expenditure. So maintenance is classified as semi-variable. Same way, power and fuel is also classified as semi-variable. The next thing is depreciation. So depreciation cost is a fixed cost. This is going to be a fixed expenditure. And next is the insurance cost, because depreciation for that year is almost fixed in nature. We can foresee it in the beginning of the year itself. And the same way, the insurance premium that we are paying, it's going to be assumed to be the constant. So we are treating it as fixed expenditure. So now we have classified these expense heads into fixed, variable and semi-variable. Now the next point, prepare the budget for 80% capacity. So given data is given for 60%, data is given for 100%, we have to calculate for 80%. Okay, and how to do that? So that's going to be very simple. For the variable item, it's very simple. We can directly calculate the per unit cost multiplied by the relevant quantity to find the variable cost of the 80% capacity. For example, 600 units, wages is 1200. So 1200 divided by 600, 2 rupee per unit is the way, because it is variable. So you can directly divide by the quantity and say as per unit expenditure. So 2 rupees per unit. So that we have calculated here, 2 rupee per unit. And for 80% capacity, what will be the production quantity? It is 800. 60% is 600, 100% is 1000, so 80% is 800. So 800 into 2 rupee per unit is 1600. Apply the same logic you can find for the consumable store. So 900 is the cost, divided by 600 is 1.5 rupees per unit. Yeah, okay, so 1.5 rupees per unit. So this is going to be 1200. 1.5 into 800 is 1200. So variable cost we have found. This will not be as simple as that for the semi-variable, but fixed is very simple. Let's go for the fixed. So we have completed the variable portion. Let me go on for the fixed portion. So fixed is something which is going to be constant irrespective of the unit of production, or irrespective of the capacity utilization. So for depreciation and insurance, it is constant for 60% capacity. It's going to be the same for 100% capacity. It is given in the question also. So for 80% capacity also, it is going to be the same. So this is called the fixed in nature. So then this is the reason for the name also, why it is called fixed. So this cost will be fixed for any level of capacity utilization. Okay, so I'm retaining the fixed as it is. So the fixed portion is over, variable portion is over. Now the pending portion is the semi-variable. So semi-variable, it is given as the first one is the maintenance, and 1100 is the cost for 60% capacity, and 1500 is the cost for 100% capacity. If you just see the per units, 1100 divided by 600 and 1500 divided by 1000, these both will not be constant. So how it will be constant? Because it is not a variable cost. If it is a variable cost, it will be constant. Because it is semi-variable, there is some fixed portion also is sitting inside. So we have to eliminate the fixed portion to find the variable portion. Okay, for that there is a very simple logic. We can find the difference between these two cost, which is 1500 minus 1100. 400 is the variation because of the variation in the capacity. So 400 is the difference in the cost. Same way, 400 is the difference in the quantity. So 400 cost divided by 400 units. So 1 rupee per unit is variable. So variable is 1 rupee per unit, and for 800 units, 800 into 1 rupee, 800 rupees is the variable portion of semi-variable. Okay, now so 1100 is the total cost for 600 units. 1 rupee per unit is variable. So which means the same 1 rupee is applicable for 60% capacity also. So 1 rupee into 600 units is 600 rupees. So 600 rupees is variable here. So out of 1100, 600 is variable, which means 500 is fixed. If you apply the same logic here, students, I think you can understand. I have taken out the variable separately. Now the balance left out is fixed only. So 60% capacity, the fixed sitting here is 500 rupees within this 1100. Same way, the 1 rupee is the variable cost. So 1 rupee into 1000 quantity is 1000 rupees is the variable portion of the sitting inside this. So out of 1500, 1000 is variable, 500 is fixed. So if you see, the 500 fixed is constant for 60% capacity also, and also 100% capacity. So the fixed portion is 500. Okay. So students, I will explain one more time the difference between these two costs. Any difference that is happening because of change in the capacity is because of variable only. So the change is 400 rupees. So that 400 is because of variable. So that is the total variable cost for the 400 units. That is the change in the quantity is 400 units. So 400 delta cost divided by 400 delta quantity, 1 rupee is the variable cost. So 1 rupee into 800 units will be the 800 is the variable cost. And fixed cost we have taken out as 500. So please take it as your homework. Please calculate the variable portion and fixed portion within this power and fuel. It will be 800 and 1000. And now you have forecasted all, or you have calculated all the cost heads for the 80% capacity. You can total it up to find the total cost, which is given in the, which is asked in the last question, which is the find the total cost. So total cost, you can just total it up and find. So where the students go wrong, it is in the semi variable. So semi variable is a combination of fixed and variable. So you have to bifurcate the variable, calculate the variable cost, and whatever is the left out, that is going to be the fixed cost. That will be constant for any capacity utilization. So friends and students, so this is what is about the budgets. There is one more illustration, but that is very similar to the problems what we have discussed in our class. Please practice all the very best, and your next video will be on standard costing. Please stay tuned. Thank you and all the best.